Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit HomeGain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to HomeGain.com. Are you buying or selling a home? Having a realtor can make buying or selling real estate much easier. HomeGain can recommend and connect you with a top real estate agent in your area. Call 866-512-7918 or visit HomeGain.com. Did you know, according to a HomeGain nationwide survey, that having a realtor working for you improves your chances by 50% of getting your home sold? HomeGain can recommend and connect you with the top real estate agent in your area. Call 866-512-7918 or visit HomeGain.com.
You're listening to Real Estate Radio Washington, D.C. Metro with local expert Ryan Sloper. Now, here's Ryan.
Welcome back, Washington, D.C. Metro, to Ryan Sloper's Real Estate Radio, and I'm joined today by Louis Cammarosano, the general manager of HomeGain. Quick reminder that Real Estate Radio is designed to build the Washington, D.C. Metro's market by giving you good free advice. If you ever have any questions, concerns, real estate, or credit related, the best number to reach out to us is 877-245-2030. That's 877-245-2030. So jumping back into what's ahead for this week as far as the market's concerned, we have two economic data markets that are going to be, two inflation reports rather, that are going to be released, the PPI and the CPI. Those are basically measures of inflation. Now, I don't really see any increase in inflation in these numbers anyway, at least the way the markets see them, excluding the increase in prices of food and energy, which we always talk about. Why are they stripping those numbers out when that's where the consumers are feeling it the most? So I really don't think that there's going to be much change there as far as the inflation's concerned, which is a good thing. If you guys remember, I always talk about inflation is the arch enemy of mortgage bonds. So if that number does come out higher, where we are seeing an increase in inflation, then mortgage rates are likely to jump very quickly. Also, there will be the May housing starts and permits will be released, which I think is likely to be another disappointment. And I think that until mortgage credit becomes more normal and less restrictive, the U.S. economy is going to continue to struggle. And Louis, talking about not only the demand, I think one of the other issues of why some of these markets are struggling is that, there is, with the credit tightening, a lot less people are able to actually qualify to buy these homes.
That's true. That is definitely true. And there's also perhaps something that we haven't discussed on this program, that many people may view buying a home as not a good thing to do.
Yes. Yeah.
So the market sentiment may be they've seen their parents or they've seen relatives or somebody. Everybody knows somebody who's lost a home, and maybe they are not anxious to get into that situation.
Right. They had a bad experience, and it's kind of put a bad taste in their mouth, and they're kind of like, you know what, we'll just hold off and rent until we can figure out what really is going to be our best option in the next couple of years.
And what the general economy will be as well.
And you know what? It's funny because I just had this same conversation with a customer the other day, and they were trying to forecast what's going to happen in the next year or two. And I said, you're playing with poison there. I said, literally, I can only tell you to worry about what's going on right now, right this second. If you try to forecast what's going to happen a year from now, I mean, we could literally be looking at, a 1.5% to 2% difference in interest rates. We could, prices could decline. I mean, they could decline 10%. I mean, we don't really know.
Sure.
But ultimately, the cost of home ownership is going to go up one way or the other. Whether it's interest rates rising, whether, even if housing prices were to rise a little bit, which probably is not likely, it's going to happen. And he was saying, well, what if I pay down my debt over the next year, get my ratios back in line? I feel like I can qualify for more of a house. And I said, yeah, you're trying to make a jump from one house to your dream home. And I said, that just might not be the way to look at it. When you can secure financing for maybe your in-between house, you're going from your starter home now to your move up, and then the next one's going to be your dream home. But I said, the important thing to take away here is locking in an interest rate at 4.5% or somewhere around there.
And you know why that's so key, Ryan, is you mentioned earlier the inflation numbers. Officially, they're low, but we know that there actually is inflation.
Oh, absolutely.
When you have the food and energy prices skyrocket. So because they're officially saying it's not there, even though it is, the smart person says, well, there is high inflation, and I can get one of these loans basically at a rate that's lower the rate of inflation of food and energy.
Yep. Yeah, I mean, it's really, I think, if you were to break down like what percentage of your mortgage would be, with a low interest rate compared to like with how much money you would spend on food and gas for the month, I mean, I would say they're probably going to be pretty close. And, I mean, if you take like around here in the Washington, D.C. metro area and you have like a $250,000 house and you can get a mortgage somewhere around like, let's just call it $1,800, and then somebody takes and tallies up what their actual gas and grocery bills are for the month, I bet you they're pretty close.
Sure.
And I mean, that's kind of a very telling factor because, the statistics were back when that, a lot of people were spending 50% of their income most of the time on housing. Especially in the Washington, D.C. metro area where you do have higher rent and it's more expensive to live here, more jobs and whatnot. But I want to kind of break this down for people too, because there's been a lot of talk out there as far as the government's been trying to push what they call QRMs, or quality residential mortgages. And I did get some interesting news this morning. I think Paul Mualu at the National Mortgage News was reporting that risk retention for lenders looks like it is dead. Now, for those of you who don't understand what risk retention is, it basically means for, if you're the ones that are supplying mortgages to consumers and you have to hold back like 5% in reserves to make sure that, if you do have a bad mortgage or whatever, you have money to cover that. Well, the problem with that is that, typically when you have things like that, it's going to drive the cost up for consumers as far as interest rates are concerned. Now, it looks like FDIC Chairman Sheila Bair, who is a big booster of risk retention, it leaves next month. And that's going to basically exit that debate permanently as far as risk retention. And by August or so, legislation is introduced that amends the Dodd-Frank bill and gets rid of the whole concept of risk retention, the qualified residential mortgage, and its cousin qualified mortgage. So what this means as an industry is it looks like the headache's going to go away and the mortgage bankers are going to be happy again, and hopefully that will be passed and trickled down to the consumers. Now, for those of you not familiar with the qualified residential mortgage that's been put on the table through Dodd-Frank, it was basically saying that, in order for them to, accept a conventional loan and to not have to go through government financing, you were going to have to put 20% down. Well, Louis, you and I know, I mean, you can go back 15 years. There hasn't been a year, not one, in the last 15, 20 years where over, even 30% of the population put 20% down. So,
no, but what is happening now is two things. That the average person's savings rate, while it is going up, isn't that great, and you probably can't put the down payment down. But I think we saw 35% of homes sold in the last 6 months were paid 100% in cash.
Yeah. Yep.
So it looks like for those people looking to get a mortgage, they don't have the money for it. And then there's a discrepancy. There's people who have so much money, they just want to run to the front of the line and pay cash.
And they're able to get great deals because they have that cash.
Absolutely.
And then that's that, there's always somebody that's on the winning side of things. And that goes back to the whole the wealth distribution that our country is going through right now. And to me, it's going to be one of the largest ones by the time we come out of this in the next 5 years, where we're having such a huge transfer of wealth from one class to the other. The rich are just going to get richer.
But Ryan, isn't it interesting that the wealth transfer is being made possible through the government programs that were designed to allow more people to own homes?
Yes. Yep.
There's actually a contradiction there, an unintended consequences, because all the government intervention going back to the 30s in Fannie Mae, Freddie Mac, and so on, and all the different government programs were designed to put more and more people into homes.
Yeah.
And we've seen that the result of those programs, and you can blame bankers as well, but the main reason is all these programs have now put 25, 30% of the people out of their homes.
Yeah, that's definitely happened. And what's interesting too, Louis, is that, we have FHA loans, which are still basically the cheapest government loan that they offer out there because it only requires a 3.5% down payment. Those loans, it seems like every 6 months or so, they're trying to raise the insurance premiums, because they have to have so much reserves, which is basically mandated by Congress in order to keep doing business. I mean, it's been shown that they're making money quarter over quarter, but these premiums are going higher and higher. So really the cost of home ownership is rising once again.
But Ryan, there's a classic example of the government mandating what the market would never bear.
Yep.
3.5% down payment.
I know.
Because maybe a lender is going to say, I want more money.
Yeah, that's true. And really, Louis, until we get back to the situation where we do have private money come back in that's willing to lend to consumers, we're never going to figure out where the market is. You know what I mean? And really, I mean, they're predicting that FHA, I mean, I believe they're up to some like 30% of all mortgages. Now, they're headed to 50%. Government's going to own a majority of these mortgages coming really fast.
Yeah, and the government's going to own them, and they're not going to be of the quality that the private sector would have lent them out at.
Yep, absolutely.
So they're going to have to foreclose on them, and when they close them, people lose their homes. In other words, you're putting people into homes that maybe are not ready to have a home and maybe are for credit risk, but because there's an overriding governmental policy to get people into homes, it actually brings them in and then has to kick them out.
Yeah. You're right. You're listening to Real Estate Radio. I'm your host, Ryan Sloper, joined by Louis Cammarosano, the general manager of HomeGain. 877-245-2030. 877-245-2030 is the number for any questions or concerns regarding to financing or credit. Interesting to note, Louis, is that J.P. Morgan released a 55-page report on securitized products as far as mortgages and stuff. And according to their research, in order to entice lending institutions to replace government lending, mortgage interest rates would have to increase 3%. Now, in the world of higher capital requirements, the mortgage rates would have to rise by over 300 basis points, or 3% from the current levels of where they're at. Now, you just think, let's say that we don't take 3%, we just take 2%. So now instead of 4.5%, we're at 6.5%. So, when they do enter back into the market, it's not going to be at these 4.5% levels. It's going to be more towards 6%.
Right, which is telling the person right now looking to get a mortgage is you're getting a discount what the market would normally give you.
Yes, and if you don't take advantage of that now, and I try to stress this, I'm like, not because I'm trying to entice people to buy now because just do it. I'm saying inevitably mortgage rates, whether it's through the inflation that's going to drive mortgage interest rates higher, or whether it's from private lending that comes back in there, rates are going higher. And
they're held artificially low right now.
Exactly, and you just have to strike while the iron's hot. That's really all it amounts to. I mean, you're not going to be able to predict. I don't think really wages are going to go up in the next year or two. So locking yourself in at a solid interest rate around 4.5%, based upon if you have great credit, 720 scores, that's the way to go. I mean, I ran it on $200,000 mortgage. The difference between 4.5% and 6.5% is an additional $3,009 each year, which is a total of $90,277 over 30 years.
And double the price of the house of the mortgage, and that's even more money.
Exactly. And that's why I've been trying to, at least educate as much as possible all the listeners out there to say, look, if your lease is coming up in the next couple months, please sit down with a professional. You can call me. I'd be glad to look at the numbers and show you, what the benefits are of locking in at a low fixed interest rate right now. I didn't even talk about even the adjustable rate mortgages right now. I mean, you have a 15-year fixed, according to Bankrate, that's quoting around 3.71% with an average of a 3.77% APR, and a 5-year adjustable rate mortgage on average through Bankrate is 3.05% with a 3.11% APR. I mean, Louis, did you hear my numbers? 3.05%.
It's an amazing deal. And also, if you consider renting right now, if you anticipate inflation, your rent is going to go up once you have rent control. But if you have a home and a decent mortgage, you're going to be laughing when inflation or the interest rates are 6, 7, 8%, and you're paying 3 and 4%.
And the people that are going to be laughing all the way to the bank are going to be who, Louis? The people with cash.
People with cash, and also the people with the low mortgage who are not renting and are not subject to having their housing costs rise 6, 7% a year.
Yeah, I mean, it's crazy. I mean, every time I look at the interest rates every day when I pull them up, I'm just kind of like, is this even possible? I mean, you and I both know that this shouldn't be possible and they're being held artificially low. But I'm just surprised at how long they've been able to keep them there.
Sure. I mean, the central banks around the world are increasing. China and India, they're raising their interest rates. Brazil, the United States is only getting away with not raising them because of the reserve currency.
I don't know if you saw, but I think China just came out the other day and they actually said that their economy's slowing down and their lending's actually slowing down, which is kind of interesting.
Yeah, but from a 10% growth rate to a 9%.
Right. Yeah, I mean, they were stockpiling cash for the longest time anyway. Yeah, it's definitely crazy. I definitely highly, for all of you listening out there, I mean, this is just, my 2 cents, but, take the time, educate yourself, reach out and call me. I'd be glad to sit down with you and kind of look at, what you're paying in rent now, what a proposed mortgage payment would be. A lot of people don't even know what that would be. You go online, if you try to use those calculators, a lot of the times you'll leave out things. I mean, if you're going to get an FHA loan, not only is it principal and interest, but you have homeowners insurance, you have real estate taxes, you have private mortgage insurance, and if it has a homeowners association or condo, you have those dues. So what happens is a lot of the time people try to figure out their own payments, and they're really not coming up with an accurate one. The most important thing to do is to sit down, get a good view of where we stand right now, where you stand right now, and where you could be if you did buy a house, if you have the means and capacity to come up with a down payment. Now, a lot of you are probably saying, well, we don't have money for a down payment. If you're a first-time home buyer, there's a lot of programs out there right now where you don't need a down payment. It's just maybe just having a $500 out of pocket and you can get into a house. Well, I can tell you all day long that when you go to rent a property, they're going to require 1 month's security deposit up front plus the first month's rent. If that's $2,500, you got to come up pocket $5,000 right off the bat. So where are you going to come up with that money is my question. So for those of you who think that it's not even a possibility, just give us a call. We'll be glad to sit down and see if it can and if it makes sense to work for you. It's 877-245-2030. It's 877-245-2030. We're coming up on a break. When we come back, we are going to jump into our Ask Mr. Credit segment.